Fund Supermart, your online gateway to unit trusts.
Hi Sanjeev. We last touched base with the team behind the HSBC India Equity Fund late last year. How has the India equity market performed since then, and how has the fund done over the period?
Sure. So the Indian equity market has been roughly flattish in Singapore dollar terms. It's recently corrected in the last few days, and the fund is slightly behind the market. So it's been interesting times, but generally flattish. So outperforming a lot of other Asian equity markets.
What was the performance drivers for the India equity market over the next 3 years?
So the performance drivers we expect are one, an improvement in GDP growth in India. So India had seen a slowdown and the economy is now picking up. That will be led by the investment cycle. So a lot more Indian companies investing in new capacity, capex. A lot of foreign companies coming in to set up new facilities in India as well. Better investments in logistics in India. So that'll be one factor, the GDP cycle. On the back of that, we think the Indian earnings, corporate earnings, profits, will also go up. So again, we remain very positive on earnings. So we think there'll be an inflection point and that corporate profits should double over the next 3-4 years. And that should then help the equity market. And the final factor, the third point, is reforms being undertaken by the government. So we're seeing, the key one we're looking at is GST. So trying to get a uniform tax rate across India. So that could be a game changer for India. And that's something which is a little bit delayed, but we're hopeful it'll happen. And that'll be the third factor.
What risk factors will you be looking out for?
So the risk factors we're looking at, the key one, as always with India, is, I guess, implementation of policy. So with the new government, it's been a little bit disappointing. I think people have very high expectations. But progress is being made. They're trying to push through different policies. They're trying to also change the nature of India, make it easier for people to do business in India. So make India more transparent. So again, if that doesn't happen, that would be a setback. GST, I mentioned earlier, if that doesn't happen, that'll be a negative factor as well. So those are two sort of risk factors we're looking at.
Has the exuberance over the Modi leadership run out of steam? How much consideration is paid to political and regulatory issues when making an investment for the portfolio?
Sure. So I think when the new government came into power about a year ago, there was a lot of excitement. So people had very high expectations, and as you said, there was a lot of exuberance. And I guess in any country market, yeah, it's very hard to match these high expectation levels. So I guess people have been disappointed, and the magic Modi factor has gone away. That's partly, you did see the market rally and then it's come back. So again, presenting a decent opportunity again for people to relook at India. But I think progress is being made. So we do look at the regulatory side. I think that tends to be more important than the political side, because politics, I think most parties broadly have the same objectives in India. There might be different routes that they use to get there. So politics we're less concerned with. It's more the regulatory side. And again, the case is to make it easier to do business in India. So to make regulations clear, the same for everyone, create a level playing field. So get in more investment, local and foreign. So, infrastructure in India improves, GDP improves, and investors, have happy returns from coming into the Indian stock market.
How is the fund currently positioned?
Sure. So our positioning is we've got a bias towards a cyclical upturn in the Indian economy and potentially even a structural improvement in Indian growth. So we favor some of the cyclical sectors. So we overweight banks, the financial sector, housing finance. So that's a big overweight. We also overweight the industrial stocks, which will benefit from this investment cycle. More infrastructure being built in India, more new factories being built. So that's the second position we are overweight. And the third one is consumption. So we are overweight auto stocks in India. So again, we expect demand to come back as the economy improves and people are more confident about the economic outlook for India. On the underweight side, we're underweight everything else, barring information technology, where we're neutral.
Thank you.